Imagine this. The S&P 500 has just hit another all-time high, your newsfeed is flooded with AI will make us all millionaires. And Bitcoin is back above $100,000. Wall Street parties like it's 1999. Yet 62% of Americans say they couldn't cover a $1,000 emergency without borrowing. Credit card delinquencies are at 2010 levels, and the average house now costs 8 times median income. Something doesn't add up. History rhymes. In early 2000 we were told it's different this time because of the internet. In 2006 it was housing only goes up. Both times the phrase was the last gasp before the fall. Today the chorus sings the same tune. Only the lyrics have changed to artificial intelligence and crypto. Valuations are higher than the dot-com peak. The stock market is 210% of GDP, and the Fed's balance sheet still hasn't normalized from the last rescue. This time really might be different, just not in the way the bulls think. Here's why the party could end very suddenly, and why most people won't even hear the music stop until the lights come on. Story. The American stock market has become the greatest show on earth, and almost nobody outside the tent is benefiting. Since the dark days of March 2020, the S&P 500 is up roughly 140%, the Nasdaq more than 180%. If you stretch the tape back to the 2009 bottom, the total return exceeds 600% with dividends. Adjust for inflation and it's still one of the longest, strongest bull markets in history. By almost any traditional metric, the market is expensive. The Cape-Shiller P/E sits above 38, higher than the peak before 1929 and comfortably above the 2000 dot-com mania. The Buffett indicator, total market cap to GDP, now stands at 210%, twice the long-term average and again higher than 2000. Margin debt is near record highs. The top 7 technology stocks alone account for roughly 30% of the S&P 500's value. Yet walk down any main street and the mood is sour. Real median wages have barely budged in 2 decades when adjusted for the government's own inflation figures, and far less if you use the cost of living basket people actually face: rent, healthcare, education, food. Labor's share of GDP has fallen from 64% in 2000 to about 58% today, while corporate profits as a share of GDP are at all-time highs. The wealth of the top 0.1% has tripled since 1989. Everyone else's has stagnated or declined in real terms. This is the two-speed economy in plain sight. A roaring K-shaped recovery where asset owners surf a tsunami of liquidity and everyone else treads water. Central banks are partly to blame. After 2008, they discovered they could rescue markets by printing money and buying assets. They did it again on a grander scale in 2020 to 21. The result? The Fed's balance sheet ballooned from $900 billion pre-crisis to almost $9 trillion. Interest rates were pinned near zero for over a decade, turning stocks and real estate into the only games in town. Risk stopped having consequences for those who mattered. Now rates are higher, but the sugar rush hasn't worn off. Most existing mortgages in the US are locked in at 3 to 4% for 30 years. So the wealth effect from housing remains intact even as new buyers are frozen out. Homeowners feel rich on paper. Renters, an increasing share of the population, face record rents. Transaction volumes have collapsed. People won't sell and lose their low rate. So inventory is at generational lows and prices stay artificially elevated. An 18-year property cycle that began collapsing in 2006 would, by the calendar, have put 2024 as the year prices should have started rolling over. They haven't. Yet. At credit cards. Revolving credit has surged past $1.3 trillion, and delinquency rates on credit card loans at commercial banks are now higher than any point since the aftermath of the great financial crisis. Subprime auto loan delinquencies are flashing similar red. The consumer that powered the post-COVID rebound is quietly cracking. Then there is the new religion, artificial intelligence. Nvidia trades at 75 times earnings and 35 times sales. Some of the Magnificent Seven have forward P/ES north of 50. Investors shrug and repeat the 4 most expensive words in finance. This time is different. The internet in 1999 was going to change everything. It did. Just not at the valuations people paid on March 10, 2000, the exact day the Nasdaq peaked. Policy is now pouring petrol on the glowing embers. The incoming Trump administration has signaled large tax cuts skewed to high earners and corporations, 2017 on steroids, deregulation of banks, potentially weakening or repealing parts of Dodd-Frank, tariffs of 10 to 20% on all imports, 60% plus on China, and 25% on Mexico/Canada. Mass deportation of undocumented workers. Each of these is inflationary on its own. Combine them and you have a classic late-cycle mix. Fiscal stimulus, looser credit standards, and supply shocks hitting an economy already at full employment and with asset prices at nosebleed levels. The bond market has started to notice. The 10-year Treasury yield has climbed from 3.8% at the start of 2024 to over 4.5% as investors demand term premium and inflation compensation. Higher yields are poison for overvalued growth stocks, for an indebted consumer, and for a housing market that only works at 3% mortgage rates. The Fed may soon face the nightmare scenario it avoided in 2022 to 23, having to choose between fighting inflation, higher rates, and preventing a financial accident, lower rates. Last time it chose the markets. It may not have that luxury again if tariff-induced inflation is broad-based. Meanwhile, Bitcoin and crypto are doing their best 2017 impression, up 400% in a year on the promise that spot ETFs and a crypto-friendly administration will usher in the new reserve asset. History says most alternative coins will go to zero, and Bitcoin itself has never survived a proper Fed tightening cycle without at least an 80% drawdown. Speculative fever rarely ends gently. Across the Atlantic, Britain watches with a mixture of envy and dread. The FTSE 100 is cheaper on almost any metric than it has been in decades. Cape around 13, price to book near 1.5. UK equities now represent just 3.7% of global market cap, down from 10% in 2008. The country has become a value hunter's bargain bin. Yet few are buying because the economy itself feels broken. Stagnant productivity, record taxes, Brexit frictions, and a government that seems more interested in fiscal rectitude than growth. If America sneezes, Britain still catches pneumonia. London remains a global financial hub. A Wall Street crash would hammer bank earnings, commercial property, already reeling, and the city bonuses that prop up swathes of the service economy. Higher US rates suck capital out of the UK gilt market, pushing mortgage rates up further and deepening the housing affordability crisis that rivals America's. None of this is to predict that the market will crash tomorrow morning. Markets can remain overvalued longer than anyone expects. John Maynard Keynes went broke waiting for gravity to reassert itself. But the ingredients for a severe correction or worse are all present. Record valuations, narrow leadership, 7 stocks driving everything, rising rates and inflation expectations, an indebted consumer showing clear strain, aggressive procyclical fiscal and trade policy, a Federal Reserve that has exhausted much of its political capital for bailouts. When the narrative flips from AI will solve everything to maybe growth disappoints and rates stay higher for longer, the unwind can be astonishingly quick. The 2022 bear market took the Nasdaq down 33% in 9 months. This one would start from much richer valuations and with far less dry powder on the sidelines. The tragedy is that a genuine technological revolution, AI, biotech, energy, is happening beneath the froth. Real productivity gains are possible. But speculative manias have a way of discrediting even valid advances when they collapse. The longer the everything bubble inflates, the more damage when it pops, and the more ordinary people, who never participated in the upside, will be asked to foot the bill for the cleanup. So enjoy the party if you're invited. Just remember where the exits are, and that the people telling you this time is different have a perfect track record of eventually being proved spectacularly wrong.